Okay, everyone, thank you very much for attending. This was certainly one out of the box, and I didn't really expect to be doing this at any point in time, but we certainly got wind probably about 3 or 4 weeks ago that the Commissioner was going to issue 17,700 letters to SMSF trustees and their auditors for those who were invested in 90% in one single asset or one asset class. Now, my feedback, and you might be able to tell me differently, but this has primarily been as a result of property investments. And from that perspective, it's certainly not in relation, for example, having 100% in cash. But I may or may not be right on that one. However, I always live and learn. This is a sharing and caring community. I want to take us through just a couple of things before I move on. Just quickly, today's also a launch. I'll send some information through the SMSF strategies and the estate planning roadshows. So that'll come out with a recording a little bit later on. That's a full day of case studies covering contributions, family SMSFs, auto reversion pensions, full estate planning. So it's going to be pretty exciting. Let's move on. So for me, is this a real new norm? Because essentially when we have a look at it, in 1999, the ATO took over the regulation of SMSFs, and prior to that date, it was APRA. And many commentators at that time said, well, this is like taking a sledgehammer to a walnut. And I thought everyone was probably pretty scared, but they certainly made a fairly good, strong case that given the resources and the number of SMSFs in those times, which was probably only around about 110, 120,000, that it was certainly worthwhile pushing it over to the tax office, which had a lot more resources. So the tax office took the first decade, or certainly up to around about 2008, maybe 2000, 2007, 2008, educating the advising industry primarily, and to a lesser extent, clients around their responsibilities, their duties of looking after self-managed superannuation funds. And really from 1999, the term switched from excluded to self-managed. So that was they became the lexicon. We saw a lot of growth in there, particularly as we went down the track, and we had simpler super where we got tax-free super, and that, remember the $1 million non-concessional contribution, which could be made up to 30 June 2007, and more than $50 billion went into self-managed super funds in that time. And suddenly with that and nil interest LRBAs, which were very in vogue at that time, and a lot of other strategies, we saw SMSF really take off compared to retail industry funds. They've been chasing our tail ever since, but we're still probably around about 80 or 90 billion ahead of industry funds, but they're certainly trying their hard to get towards us. The tax office, though, essentially provided the next decade, certainly from 2007 till probably, I would say, just the start of this year. They've really spent a lot of time building rulings, guidelines, looking at taxpayer alerts. You've probably seen many of those ones as well. And given the advising community, not necessarily the trustees, a lot of information. At the same time, probably in the last 4 or 5 years, they've been putting a lot of information up on their website. For example, can you run a business in an SMSF, or what happens in my T-bar, so on and so forth. So there's a lot of information there for us as practitioners. There's been a huge slowdown in the rulings and guidelines. The NTLG superannuation has disappeared, and essentially what has happened is the Commission's basically said, look, whatever we're going to do, we're going to put it up on the website. Now, for us, the two aspects is, obviously there's the general view of the website, but then there's the professional side, and more importantly, where I look is the legal database, which is absolutely crucial when we're dealing with a particular issue. Now, we're starting to see a switch, and I think that this is the first time that I've seen certainly a large-scale intervention by the tax office into SMSFs. And this is now my 25th year in SMSFs. I've been there right from the start, so it'll be great having this roadshow that this is going to be my, in fact, 25th year presenting on this sort of stuff. A good question, why they contacted the auditors. I'll have a look at that issue in relation to auditors. So thank you for that, Lorelei Minter. I'll have a look at that, and I'll be covering a lot of these issues as we go through the track. Now, when we have a look at this ability now through the data, a lot of data matching, a lot of the information comes through the tax returns and compliance returns. Effectively, we've got big data compliance, and Commission can now find out who has got quite significant amounts of property sitting in their SMSF. So it was a huge stretch, and I will take you through those two letters, both one to the trustee and also one to the auditor, and I'll cover why it's a particular case. But it looks to me as though the person signing off on these letters is John O'Halloran, who's the new Deputy Commissioner of Taxation and Superannuation. So there's been a change at the top, and quite clearly compliance is now a big issue. And it's quite surprising that when we have a look at it, we've got the Commission going directly to the trustees and also the auditors and bypassing the accountants and the administrators. I mean, we did, obviously it was leaked that these were coming out, so we're all sort of put on notice, but I'm sure many of you have had, quite gut-wrenching telephone calls from clients saying, what the hell's going on? And we really need to now is address that issue, and that's what this session is about, going into the law, looking at what's coming out, and more importantly, coming up with solutions now rather than sitting on our hands. Really, from us though, that this is, as I said, the thin edge of the wedge. This is the start when we've got it. From the next stage is we've now got to look at, where else will the commissioners start to get a lot of detail in relation to that. It was actually good, Jason Spitz. Thank you, Jason. Again, thank you for doing that. One of our most brilliant SMSF writers in the country. Sorry to pump your thing, but he's got Grant, to your comments to where the ATO is writing SMSFs with high weightings to non-property, confirmed yesterday on LinkedIn that most of the SMSF getting letters were invested in property, and the letters were a result of the ATO's concerns stemming from the Council of Financial Regulators report earlier this year. So thank you very much for that. Good on-the-ground reporting, but yeah, definitely it was a lot of property, and certainly the solution I'll come up with later on has been very focused, our investment strategy is very focused on the property side. But notwithstanding that, absolutely we need to make sure that we've got evidence all the way down the track. So I thought I'd start at the start and actually work out, well, what is strategy? And this is the key part for us. The Oxford definition of strategy, and there's half a dozen of them, is really a plan or course of action to achieve a certain goal. That means that in our lexicon, particularly as advisors, and if I look at a trustees, because ultimately the Commission says the trustee is fully responsible. But again, if we're advising the trustee in relation to that, we've obviously got to be careful, particularly when I have a look at some of the downsides, and I turn my attention to Section 55.3 and Section 54B of the SIS Act. So in terms of an investment strategy, which is a requirement under the SIS Act under 52B2F, SIS Regulation 4.09, and many SMSF trustees obviously incorporate that. However, those covenants contained in Section 52B, which are specific to SMSFs, are deemed to be imported into the governing rules of the deed if it is silent on that occasion. So it's very unlikely that, well, it's very unusual for regulations and also laws to be imported into the deed or the governing rules, except in these limited cases. So investment strategies for reserves, etc. So when we have a look at that, it goes through the process that we need to lay down an investment objective. And that investment objective is what our investment strategy is moving towards. And I'll cover the ones that I've done in our investment strategy so you can have a look at, but I'll also be mindful of also ones that have not gone across the line. I want to show you an example of a particularly poor one very shortly. Now, a strategy is, and this is absolutely crucial, is an investment strategy generally needs to be put in place as from the 1st of July or shortly at the start of the year, looking forward as to how the fund is going to invest its assets, what's the strategy for investments to meet the objective going out to the end of the year. So, for example, where we're at the moment, the investment strategy should be looking for 30 June 2020. We certainly shouldn't be doing an investment strategy now for 30 June 2019 because the year is already completed, which creates two issues there. And I'll come back to that when we look at the auditors. But effectively, what we need to do is we need to have an investment strategy in place as a forward-looking document. The danger is that if we promulgate or produce an investment strategy at the same time as we're producing our accounts and our audit reports, if that's when the investment strategy is actually completed, it is way beyond the time limit for that income year. And as a consequence of that, that is not an investment strategy relevant to that income year, because it's more a historical record of where we've been, which then creates obviously great concern for advisors, trustees, auditors, and also administrators, as we will see from the next slide. So when we have a look at no investment strategy, as I said, if this is simply a record of historical issues, then what would have there is that there's no investment strategy. And what I'm going to do is just going to simply take you out of here. I'm going to go into the legislation, and I think I've got it here somewhere. I might have it, might be sitting on my website. So let me, oh, I know where it is. So if I go in and have a look, the other one, sorry, we've just got a little bit of a boogeyman there. So here we go. So if I have a look at the investment strategy rules, and in fact, I was shocked. I did a session on this morning to my subscribers, and in fact, their comments actually, these laws have all been updated. So I'll take you through. So you're the first guys to actually look at this. So section 52B is, as I said before, the covenants to be included in the governing rules, self-managed super funds. So these are now specific, and the liabilities are also specific, and I'll go through it. So if the governing rules of self-managed super fund do not contain covenants to the effect of the covenants set out in this section, those governing rules are taken to contain covenants to that effect. So we've got two, the covenants referred in subsection 1 of the following. So to act honestly in all matters concerning the fund. For our perspective, we look at subsection F. So this is 52BF, which says to formulate, review regularly, and give effect to an investment strategy that has regard to the whole of the circumstances of the fund, including, but not limited to, the following: the risk involved in making, holding, and realising, and the likely return from the fund's investments, having regards to its objectives. Again, as I said before, there needs to be this plan or this goal, which is objectives and its expected cash flow requirements. The composition of the fund's investment as a whole, including the extent to which the investments are diverse or involve the fund in being exposed to risk from inadequate diversification, which is where the Commissioner picked this up. I mean, the Commissioner could easily come out with a guideline that auditors need to check objectives and investment strategy flowing through the objectives, which is one of the key components. But he's simply gone diversification, as Jason said, is it's a sole focus in on property. So by attacking property, it's a way of saying, well, the easiest way to get to property, to me, would be cash flow and diversification, as we'll look at later. The liquidity of the fund's investments have regard to the expected cash flow requirements. So, for example, when we have a look, if we're solely 100% in property, we're 70 years of age, we're getting a income stream from the pension of what is it? If you're 70 years of age, it's around about 5 or 6%. It's 5%, and then we find that the underlying yield for the property, if it's solely invested in property, is only 3%. Then there's obviously a significant issue there in relation to both cash flow and diversification. There's a risk there. Fourthly, the ability of the fund to discharge existing prospective liabilities, which I just covered there. But compare that to, for example, that someone might be 40 years of age, a couple of Gen Xers who pull their money into a new SMSF, then gone and acquired a property which they intend to service through contributions and also rent, and we've got cash flow positive, but they do a long-term hold on it, and basically said that their realisation date is going to be 30 years down the track. Then in that system, then we've got a plan. The objective is obviously to maximise retirement income and for pension purposes. Secondly, the strategy is to do a long-term hold to maximise the growth there and also maximise the underlying income from that investment, because where we start now, if they've bought a property with 400 and then they've geared another 50%, so it's an $800,000 property, the yield they might get on it now, let's say it's 3% or 24, by the time we get 30 years out, it's probably going to be like a $80,000, $90,000 income coming through for that year. So we've got to monitor that diversification at that present point in time. But long term, it seems to be okay. Even if it was untenanted, it's the only issue you're going to do there is a cash flow issue. will contributions cover that? So, and the longer we're in that property, the more cash that's going to be thrown up, the better. Now, of course, diversification is not a bad idea to, as we throw up surplus cash, to also have a plan in place that we will diversify out of just property. Now, let's just go down from that, and 52C simply puts in place directors' covenants. So what we want to do now is go down to 54B. This is a brand new section in the legislation, that actually 54C, which applies to self-managed super funds. 54B and 54A relate to more industry and retail funds and public offer funds. So 54C says a person must not contravene any covenant contained or taken to be contained in the governing rules of a superannuation entity. So, for example, when we look at that, we know that an investment strategy, or a requirement to do an investment strategy, effectively is a covenant that is generally under the governing rules, or certainly pertain to be included in the governing rules of the superannuation fund under section 52B for the self-managed super fund. So I think that's pretty evident. So it's important that a person must not contravene any other covenant. So the danger here we've got, and if you just walk with me on this one, is that if we have a look at the covenant being the investments must be made in line with the investment strategy, then in those circumstances, what we have there is those investments being in line with the investment strategy. If we make those investments and there is no investment strategy, then we've actually breached that covenant. So then it means, well, who actually didn't result in that investment strategy? And it's any person. So that could include an administrator, an accountant, an auditor. Obviously, will include the trustee. Now, it's not an offence. It doesn't contravene or result in invalidity. But if we then go down to here, subject to subsection 4A, a person who suffers loss or damage as a result of conduct of another person that was engaged in contravention of section 54C may recover the amount of the loss or damage by action against that other person or against any person involved in the contravention. So anyone who's involved directly or indirectly in that contravention can get swept under this section 55.3. But there is a defence, and that defence effectively, if we go down, and this has nothing to do with the tax office, this is members or trustees, anyone who's aggrieved as a consequence of a loss or damage can take an action. So defences in action, it is a defence to an action for loss or damage suffered by a person as a result of making an investment by or on behalf of a trustee of a superannuation entity if the defendant establishes that the defendant has complied with all of the covenants referred to in sections 52 to 53 and prescribed under 55.3, which is obviously the case, that the investment is actually covered in there. So we're not a bad position there if we can show that investments are covered in there. Let me just have a quick look at some of the questions. Scott Grogan, usually ATO sends a spreadsheet of impacted clients. I requested one but never received an answer. Scott, thank you for that. As I said, I think this is a new broom in town, John O'Halloran, as we're going to see. I think they're going directly to trustees. And you may have well seen that when you set up an SMSF, trustees are actually getting directly calls from the tax office themselves. Gurev, I've got not a question, but just a request if you can speak a bit slowly, going very fast. Sorry, I've just got a lot of material there, Gurev, but I will have this obviously available a little bit later on. I've got here from Ken Race, what if property has no debt, is yielding 4%, which is double interest income and deposit? Client then can have a buffer for tenant, but no tenant may be up for only a few weeks. I'll cover that question when we have a look at our investment strategy. I've got here, Darren, won't the property yield stay broadly the same as the yield beyond the market value, not the cost? Yes, but what happens there is the cash flow increases over time. So you're right on that one, Darren. Again, I'm a lawyer, not a brilliant investment. You're right, the yield will be increasing, but the actual underlying cash will be increasing over that time. Which section specifically states investment strategy needs to be in writing? No, there is no section, Scott. The problem about it, particularly when we have a look at the Commissioner's letters, and no auditor is ever going to be signing off in relation to a verbal investment strategy. mainly because you'd simply get if it ever came to court, you'd put the client up on the stand and it would all fall to pieces, which means that it's your responsibility. FOM, if a client's present super balance is over 90% in one asset class, how long do we have the investment strategy to bring it under 90%? I'll have a look at this when we go through the stage. I've got another one here. Just a thought, if the only asset in this SMSF is a property and cash at bank, and the market value of this property has been substantially reduced, assuming there are only accumulation accounts in this SMSF as a result, the member's account will have a negative taxable component, but positive tax-free. Can this happen? Yeah, absolutely. So if you do go into negative, and look, if there's an underlying LRBA, it may be the case, depending on the underlying equity, we may go into a negative equity position whereby because it's a limited recourse loan, it can be handed back to the bank or the related party lender. And we can, in fact, I've been in a position where we can get rid of our taxable component and move into our non-taxable component. So look, this is a really good strategy, and I will be looking at a lot of this stuff. What I'm doing is this just one little strategy I'm looking at throughout this session. So we've had a look at the law. We also had a look, and I just want to throw you back. Let's have a look at this little case study that I've got here. So you can see here, so we talked about 55(1) breach and 54(b) breach. So let's look at XYZ ETF. So we've got an ETF that's sitting in the fund. There is no investment strategy. You have to excuse me, I'm about to sneeze. Sorry about that. So we have got an investment strategy. There is no investment strategy. I'm going to show you something there in a second. It's fallen in price by 20% and booked a $50,000 loss. So as a consequence of that, obviously, can the trustee or the members of the fund take action against the auditor or the administrator, whoever prepared that investment strategy? Well, having a look at 54(b), there has clearly been a contravention. If that underlying investment has been made and there is no investment strategy, then there is an action against the administrator or potentially the auditor in that case. And remember, after Cam and Bear's case last year, auditors are in a very dire position with negligence anyway. But if we have a look at that 54(b), it's a lot more powerful because what we have there is it's a strict liability provision. So potentially they're all on hook for the loss. So for us, we've got to be careful. Do we want to get involved in the investment strategy or not? Importantly, an investment strategy is not a financial product in terms of the Corporations Act. So an accountant, you have got the ability to do investment strategy, but be very careful about what you do show or not show to your client. Prepare a simple one that's prepared after year end. And really, as I said before, it should all be done now, effectively is going to create a lot of concern. So what I want to do now is get down into the nitty gritty. We've had a look at the law, we've had a look at the regulations. I want to look at the ATO letters of the trustee and auditor. I then want to look at investment strategy that crossed our desk. Then what I want to do is show you a letter which I would suggest that this will be accessible for you after this event to send out to the clients that covers this issue. And I would say, well, do you just send it to those affected or basically to all? I'm then going to take you through our investment strategy and show you how we've covered the diversification issue, and then we'll move on from there. So let me just jump out or bump out of here and start to go into a few PDFs I've got here. So this is the one from the auditor. I'll actually go to the ATO one. So I'll just blow this up perfectly. If you haven't got a copy of this, you know, it's I'm sure I'm happy if you want to come here and discuss it, or if you want to send a notice to me at support@lightyeardocs.com.au, we'll send it through to you. Again, there's no name on this, so it's fine. So, dear trustee, and this is pretty scary. As I said before, I think, Scott, you said that normally the Commissioner gives you guidelines, but it seems to me as though there's been a purposeful strategy, there you go, a plan on cutting the administrators, etc., out and starting to attack both the trustees and the auditors. Our records indicate your self-managed super fund investment strategy may hold 90% or more of funds in one asset or a single asset class. This means that your fund may be at risk of not meeting the diversification requirements as outlined in the operating standard of the SIS regulations, and obviously we saw the SIS Act. As a trustee, you're ultimately responsible for ensuring your investment strategy meets the requirements under the law. You could also be liable for administrative penalty of $4,200 if your investment strategy fails to meet these requirements. So you need to review your investment strategy to make sure it complies with the law. So when do they have to do that? Well, obviously you've got to do it right now. And what investment strategy should they be looking at? Well, obviously it's the 2019-2020 investment strategy. I'd also be looking, because there's an audit coming up for the 2018-2019, they also need to look at that as well. Now, here's where it comes in. I think the issue about, Gaurav, I think you were talking about whether it needs to be in writing. In particular, you need to be able to provide evidence, ideally within a written investment strategy, of how you consider the following: diversification, risk involved with inadequate diversification, and making holding. A lot of this stuff is just straight out of 4.09. Have your investment strategy ready to provide to your SMSF's approved auditor as part of your next audit. This will help your auditor form an opinion on your fund's compliance. So now it's up to the auditor to determine whether the investment strategy meets the requisite diversification. But it also actually puts the auditor on notice, on a broader perspective, that investment strategies are a key requirement, and all such investments sitting there need to be reviewed. So what happens now? We will also be writing directly to the auditor of your fund to notify them of our concerns. You should be aware that if the audit identifies you have failed to rectify any non-compliance with requirements listed above, this could result in your position of above-mentioned penalties. So pretty scary stuff for your clients to get that. And I hate to see, let's face it, these days we don't get many letters, but when you see something like that, it's pretty scary. So that's James O'Halloran. Let's have a look at the auditor. The auditor one is really not much different. So, dear SMSF auditor, we've recently written to all SMSF trustees where records show that blah, 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 makes the same sort of thing. The letter reminds trustees the requirements under Regulation 4.0 include the need to provide evidence in their investment strategy of having considered diversification of the fund's investments, the risk involving with inadequate diversification. It also advises the trustee to have their investment strategy containing evidence of their considerations ready to provide the auditor as part of the next audit. As a consequence of that, I would say there's no auditor in Australia or the world that would sign off on a verbal investment strategy. Now, it is up to you to determine whether any contravention Regulation 4.09 on the basis of non-compliance with the above list of factors would amount to a material contravention resulting in modification of the audit report. A couple of things on that. One is that if you do, for the auditors on here, and I'll get to the questions in a second before I move on, the auditors involved here, if we do put a contravention, there's two things that happen. One is there might be an immediate fine here of $4,200, depending on the commissioner's largesse. The second one, under Section 45 of the SIS Act, essentially, in particularly for Section 42A of the SIS Act, if an SMSF breaches any of the legislation or any of the governing rules, effectively what happens there is that fund is a non-compliant fund. And then it's up to the Commissioner under 42A5 to effectively provide a notice that that fund is a compliant fund. So I won't go into the legislation there, but we've just got to be very careful, and particularly administrators, accountants and trustees, we need to get really involved with the auditors here. One of the things, I'll talk a little bit further about the auditor's role. An auditor contravention report should be lodged, blah, blah, blah. If the trustee is receiving advice about the contravention first time, you should notify them in writing. Best practice would be for the SMSF auditor to notify trustees in the management letter of any further concerns. So let me just look. Well, it looks as though I've got a few questions coming here. So what if the strategy includes a clause that trustee members accept the risk of non-diversification? So Lorelei, I'll have a look at that inside our strategy a little bit later on. Could investment strategy, says it's from Russ Tuff, that shows your strategy is to have 5 houses and move to diversify in the shares of collectible art after 5 houses achieved and paid off. This is a strategy done yearly, which should be covered. I would say so. Again, let me go through and have a look at the evidence that you really need to require to show that strategy. Again, the strategy there is not a bad strategy. It depends. So Russ, if you're like 70 years of age, no. But if the strategy there is to collect that, they're 40, 45, 50, they're not going to retire, don't need cash flow for a while, then basically it should be okay. But again, we've got to come through. As accountants, don't we need to consider AFSL requirements when assisting clients with their investment strategies? That's from Vic Creta. No, sorry if I said your name wrong. No, not at all. Investment strategy, remember you are advising the trustee of the fund. If you advise a member to roll the benefits over, take a lump sum, take a estate planning, etc., that's a financial product itself. When it comes around to advising the trustee, and there's quite a dichotomy, a divergence between the trustee and the member, effectively a financial product is not an investment strategy. If you then go down and talk about the underlying investment, except property is excluded, or gold, if I go and say to the trustee of the fund, well, we're going to set in place an equity investment strategy. It's going to be between 40 to 60% of the funds. And what I suggest is you go and invest in AMP or want to short AMP. Then in those circumstances, when we go that stage, then you obviously need a license. You don't need a license to help prepare an investment strategy. Are only ASX shares considered a single asset class, although the shares generally is the case, and that's why it's really strange that if we have it all in equities, then effectively we've also got a diversification issue. But again, it depends. I mean, if I have a look at it, the risk involved in diversification is that if we have a look at the market at the moment, you know, if someone's at a later stage of life and then they lose 30 or 40% because the market falls, then potentially there's an issue. We need to cover that in terms of diversification. So it does work well, and I've covered that investment strategy. We've got here from Lorelei, great for the question. So if the trustees members have an investment strategy that have considered requested items, then the fund should be okay. They just possibly need to add something extra to the strategy where they have a high concentration. I would assume they would apply to those funds that just have a bank TD. Absolutely. But again, it depends on what we've got in terms of evidence. Grant, this is from Chris Prister. Does the letter being sent to the fund auditor specify which client the letter relates to? It doesn't seem to. It looks as though it's just relating to that. I'm presuming there, unless some of the auditors can tell me, have you received notification as to the relevant auditors? Or perhaps the Commissioner just assumes that the auditor should be aware of who has more than 90%. Gaurav again, hi Grant, it's a valid argument. If a person owns more than 90% of the assets in his SMSF in a property, and his or her partner has a retail super fund which is invested. No. Unfortunately, investment strategy is per fund. It's got nothing to do with outside assets, which I saw many years ago, planners would say it's okay to have 100% in like property, and then you've got plenty of assets. In fact, the reverse one, you could have 100% shares because you've got plenty of property outside. They're both different. One is you're advising the trustee of the fund. It's got nothing to do with members' assets outside. The ATO, so Darren again, the ATO letter refers to a single asset class. A trustee who's investing exclusively in equities under review. Really, this applies from an auditor who should be both sides of the equation and including cash, of course. From that perspective, they haven't looked as though from Jason, it looks as though they haven't gone out. It's simply been a property issue at this stage. But again, this is a thin edge of the wedge. Paul Hennessy, can we get a copy of the audit letter with the slides? Absolutely, and I'll send both. Again, they're on a no-names basis. I've just got a couple more, and then we'll move on. So Lorelei said, why are they contacting the auditors? Mainly because they're putting the auditors are really the gatekeepers for the SMSF, for the tax office. So the ATO, the auditors need to be put in place, and I'll come through that a little bit later on. Who says that investment strategy prepared with the year-end docs looks backwards? The ones we did not show financial years they related to. Logically, investment strategies are a plan for the future. Absolutely. So, John, look, I don't mind how you do it, but there should be a date that the trustee accepts that investment strategy. If there's no trustee acceptance of the investment strategy or formal minute for that effect, then you don't have anything evidence which could be adduced to the tax office. Okay, so let me go in and have a look here. So what I've done is I've taken all of that. As I said, James O'Halloran's obviously a new broom on the block. A lot of the issues that you guys raise about equities, LRBAs, I wouldn't be surprised to come down later on, because the tax office does have all the big data to come down and have a look at related party loans and start to send letters out here again. How would you do that? I'll be sending it out to the trustees and the auditors to check related party loans, or even unrelated party loans. Or alternatively, there is a requirement to look at borrowing that comes under the cash flow requirements in terms of the investment strategy. So again, I would see a lot of this sort of stuff coming out. Again, this is only investment strategy. Expect a lot more coming out from James O'Halloran. As I said, we've switched into a brand new gear, and there's still a lot of strategies on offer. We've just got to make sure that our evidence is really squeaky clean. So let me just show you here a investment strategy that was sent to me, and let's have a look, and you tell me whether you think this is an investment strategy. So the objectives: the trustee fund aims to provide super benefits to members to meet their retirement needs, ensure the appropriate mix of assets are owned by the fund. So that's sort of a bit of wishy-washy, etc. The trustee's general investment objective: achieve real medium to long-term growth while maintaining a low level of capital volatility. I think that's a bit dangerous because we're always living in capital volatile times. To achieve this objective, the trustee has determined the fund will have the ability to invest in the following areas: equities and stocks, managed investments, cash interest-bearing deposits, and any other investment legally able to be made. It is noted that the trustee may from time to time seek professional advice in the formulation of investment strategy. In determining this strategy, the trustee will take into consideration the aspects of the investment in accordance with the fund's objectives and appropriate legislation. The policies adopted by the trustees to adhere to these objectives are continual monitoring the performance of the fund's investments, rate of return, risk analysis, and expected cash flow requirements. Balancing the asset portfolio's result adjustments to market conditions. The trustee will ensure investments continue to comply with this strategy. However, the trustee reserves the right to alter the strategy at any time. Now, obviously, investments and blah, blah, blah. Now, how many of you think that that is an investment strategy? So this has come across my desk. In order to ask me, do you think this is an investment strategy? I can tell you straight away, having a look at the guidelines, the Commission's guidelines, that in no way is an investment strategy. In fact, it's a complete waste of time, which then throws us into section 54B. And look, as an auditor, you shouldn't even be looking at that. In fact, I'll be raising an issue straight away in relation to that. So let me just jump to what I've got a couple of little things there for you to look at. So in LightYear docs, we've got a couple of little things here. If you go to our support centre, I put this up this morning, and I will put up I'll put up some resources later on for you to use. But if we have a look at the client documents and advice toolkit, so it's simply going to support centre, client documents and advice toolkit. By the way, our webinar and how-to videos, that will be sitting down here later today, so you'll be able to access that with the slides and the ATO letters if you want. Now I'll go in here, and there's a couple of letters there. There's a client deed upgrade letter. Again, really, you should be upgrading client deeds every 1 or 2 years. Go and have a look at that anyway, but that's a separate element there. So you download, it's a Word doc. So the suggested documents there. So I just simply download. I've got my doc popping up here. So it's just popping up. Hopefully you can all see it. So again, this is for your use. This is just a sample from us. So we've got a sample investment strategy and indemnity letter. So this is what I would strongly suggest that all of you do. I won't go through a lot of this. It simply talks about the letters that are being received, so on and so forth. So we've got 3 options here for you. The first one is you're comfortable that the investment strategy that you've currently got for your client, particularly in relation to 2019, 2020, is A-OK. 2018, 2019, then that's an issue for you. If you're comfortable with that it meets 52B2F and regulation 4.09, then no action is required. And it's not just this one with property diversification up at 90%, it should be all investment strategies. Secondly, the client agrees to update the fund's investment strategy to go down this track. And then you can obviously use the LightYear docs investment strategy automation, or the client doesn't want to pay for your advice, wants to ignore it, then we need to get an indemnity from the client. And that would also, I would suggest as well, the auditor, if they don't, with an auditor, if a client doesn't want to go ahead with your suggested notes, forget about the contravention notice, make sure you get an indemnity there because you don't want to get caught under 55.3. So let's go through the letter. Again, you put your details in there, clients' names, etc. And then we've got the Commission of Taxation. I do go back to, I think, was it Scott that you said that normally get a letter from the Commissioner it's going to be a hard one to know which one of your clients has got this unless the commissioner comes out. But I'd go down this track, and I personally would send this to all clients, really. So a number of our clients have received letters from the commissioner stating the following. So blah, 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 investment strategy, diversification, so on. So this is all straight out of the commissioner's letter. Importantly, an investment strategy is a forward-looking document. The trustee must have one in place for the income year ending 30 June 2020. So that's the truth. This should be completed in the next 60 days before we advance any further. As I said before, you can't do an investment strategy after the end of the year because that's a historical record. Given the commissioner's Blitz on SMSF investment strategy, the responsibility of the trustee to complete one for 2019-2020, the possible $4,000 fine, we highly recommend an implementation review of the fund's current year's investment strategies. We are happy, so this is you as advisor, conduct this for the trustee of the fund to get the investment strategy into full audit shape with relevant work papers, trustee minutes, and relevant reference materials and guidelines. Mind you, at this stage, what I would say is that once you get the investment strategy, or the types of investment strategy you're doing, is you should be dealing with the auditor at this time in investment strategy, not later on. Get involved this time. Likewise, auditors, it makes sense for you to also push the button to get advisors and administrators to start prepare investment strategies at the start of the year. Otherwise, how can you sign off it's an investment strategy if it's been prepared at a later date? How are you going to know that? We'll simply look at the trustee minute to see the date when the investment strategy was signed off. Now, the fee for the service, you're not going to do it for nothing. I've put in their suggested fee of $350, particularly given the $4,200 fine, but it depends on where you're coming from. It's important to complete this task immediately given where we are in the 2019-2020 income year. Alternatively, you can review the funds and investment strategy yourself with regard to all of the above factors. Now, some of you may simply say, look, to the clients, go and get your own investment strategy. And if you do that, there's two things. Tick one of the boxes. One is they tick, we hereby seek to proceed with a detailed fund investment strategy review and preparation to meet Legislative Commission of Taxation guidelines. We will invoice the fund for this service, and you might just be charging the fund for an ongoing service, which includes the investment strategy. So therefore, you might just include this anyway. Or no advisor review of the fund investment strategy. We hereby disclaim all liability for damages, costs, and fines for any professional SMSF advisors in relation to the fund's investment strategy. So if they tick that box, make sure you get it signed. That gives you an indemnity, which to me is absolute minimum. So let's just move away from that. Again, you can find that on the support centre. Please feel free to use that. Until I've been listening to a boogeyman, so sorry about that. What I do here is I go to the LightYear docs. I'm under the LY strategist, which means I'm on an unlimited subscription. Alternatively, the investment strategies here are effectively only $49 if you want to do that. But again, if you like to license our platform, which is, we've got some great offers on that. Alternatively, unlimited, you can do that and really start punching. I mean, if you've got 100 clients or 100 investment strategies, you're in a pretty good position. So what I'm going to do now is I'll just go in. I always find if I'm looking for something, especially as we go through the search facility, I look for the investment strategy for the fund. And I've got a lot of stuff there, as I said, 49. I'll go through exactly what we've got. It's pretty easy. So I'll go the Abbott-Family, and then I'll go into that one. Should actually be doing my one. So I go start, and then what pops up is our pretty advanced automation system. So it's working behind the scenes. So here we go. So let's go through and I'll take you through what we've got. So the Smith Family SMSF, or Super Fund, we can do that. And there are a few questions popping up. So let me finish this and I'll get to the questions. On what date will the investment strategy be established? Well, in theory, if this was me, it's the 1st of July. Now, what's the end date of the current income year? So this is 30 June 2020. Now, I've left that open because what you can do is you need to leave it blank. So you could actually have found one of these for a prior income year. Now, if you're going through this, generally you want to save answers on the way through, just in case you get a call or whatever. You want to make sure you've always got an ability to get to it. And there's also, it's all included in your vault anyway. Enter the trustees details. Let's get a company trustee. So I'll call it Smith nominees. Put the ACN, it has to be in that sort of format, 454 324. Put in the company address, which is probably going to be your address. Street, Sydney. Now, if you leave one of these blank, one of these major ones, you'll find that it pops up with a blank in the document, which we'll see. But you can always go back in and change this. You've got 30 days to change it. So let's have 2 directors. We've got, I did a whole session this morning on family allowances to our subscribers. And also SMSF overdrafts, but I haven't got that here for you. So we've got John, I simply tab, and then we've got his spouse, Judy. So they are the 2. Now, what I want to do is make sure they're both the ones who are signing. So far, not too bad. We are going in to integrate with Class and BGL. So a lot of this will be auto-populated for you, so it's not a bad thing. Okay, so here we go. This is the meeting that evidences the acceptance of the investment strategy. So we can leave it blank. Ideally, we'll do that. We can effectively, if it's going to be the same place, I simply select that button because I've put in Smith Street. They come to your office. Who's the chairperson? We've got John Smith. So let's say that we go back and the meeting was held on the 1st of July or thereabouts. So that's for the current income year. So the next issue is we now go through each of the asset classes. Now, embedded into the document is this copy which deals with the asset. So what we need to do is we need to put a benchmark in there, and 0 to 100% is not a benchmark. So if we've got mainly property, we might sell some of the properties. So we can say probably at least, let's say 5%, 5 to 40%. I don't need to put the percentages in. I just need to put 5 and 40. International cash, 0. Oops, that's an O, not a 0. Then go to the next page and have a look. Domestic fixed interest, I'll put 0. International fixed interest, I'll put 0. Go to the next. Equities, at this stage, I haven't got anything, but let's put in there 0 to 20%. International equity 0. The reason I do that is that if we do get extra cash flow, which we've got in the copy, that may be diverted to equities, which is to cover our diversification over the period. Okay, domestic property. So here we go. Look, we're primarily, we've got 95% in, we've got 90% in domestic property. So what I'll do is I'll go 40, because we might sell during the year up to 90%. Now, what I've done here is if we're more than 50%, I think it's not a bad idea to check this box. You'll see why when we get in. So let's say we've got residential, and what have we got there? Residential can be anywhere from 0 to 40, and I'll tick industrial 0 to 50. So that pops up. International property, I've got 0 there. I also see there's a couple of interesting. I've got alternative assets such as hedge funds, private equity, futures, derivatives, crowdfunding. I haven't got anything there. And also an investment strategy. You can also put in a, you have to put in a borrowing. Let's say we've got 50%. So we've got 40 to 60% sitting there. That's our borrowing. Now we can create a custom asset class. If we wanted, I could put in gold. I'll put the characteristics. So just copy the little characteristic, time frame, etc., etc. But I'm going to go no because I'll generate that document now that we've got that. So we're going to go down and we're going to have a look at the document that we've got there. And that will pop up for us. And it's just being generated, so it goes into the server. These servers are based in Australia, so you have full access to it as we go down the track. So it's just taking a little bit of time. So I'll download that document. It comes up in a PDF. If I want at any point in time, I can go in. You can see what it says My Vault. If I go into My Vault, I can go down and I can see the Abbott-Family. Obviously, I've got a lot of testing there. There's the investment strategy of the fund. I open that up. And you can see there it was made. This is the document reference number. It was made at 1:20. Now let's have a look at the investment strategy that we've got here. So we've got the LightYear docs. We've got the investment strategy. Sorry about that. I've got to go back up here. I'll go in, and if I wanted to, I can relaunch that. Alternatively, I can download it. So again, I've already downloaded. I'm just showing you where to go, but I've got 30 days to relaunch. So this is the investment strategy, and you can see there's a guidance statement. There's no, ordinarily with most of our stuff, there'd be a PDS, but there's no PDS here. It's just simply a guidance statement. So we go through the detail, which is important for the client, trustee and SISA. We also go through the ATO guidelines, investment objectives and strategies and what's required. This is straight out of its audit stuff. The 5 steps to investment strategy, as I said, investment objective. And then you'll find here we've got, it's pretty well honed, not to property, but it's more well honed to ASX and stocks, etc. there. So there's a lot of stuff in there that we've got. We've also covered insurances and so on and so forth. Now we go into the investment strategy itself. So you can see this is quite different than the one we saw before, which was an investment strategy. So it's for the Smith Family Super Fund. We go down. We've got their fund's investment objective. The trustee, via its investment strategy, seeks to maximise the fund's members' retirement benefits, including income streams and lump sums, as well as maximising in-death benefits if the members' superannuation benefits are not being used for pension purposes. We've got the background there. As you can see, that really just follows what was in the audit letters, etc. We've got asset allocation, which we're going to be popping up very shortly on that one. We cover risk in there. Borrowing in there, diversification. We've put in quite a big bit on diversification. One thing here is this is the box. Quite here we've got diversification is best seen by the spread of the fund's portfolio across a broad mix of assets. At the other end, where a fund applies an asset allocation 90 to 100%, property with 0 to 10% cash, and this is exemplified by a single property, there is inherent risk in if the property drops in value. Cannot be tenanted. It's impacted by a natural man-made disaster. More importantly, if one member dies, gets divorced, or is retired and needs a lump sum. A fire sale of the property to meet the trustees' cash flow needs to satisfy members' request can result in significant losses. So we actually put that up front, and so it means at least we've thought about it through here. This is another box that pops up. The trustee, like if you didn't tick that 50%, then this one doesn't pop up into the investment strategy. The trustee of the fund has decided to invest in the residential property, industrial property. Remember, we tick those boxes as a long-term hold, that's 10 plus years. And although the asset allocation is significant, the contribution of members and rents ensure the property is cash flow positive with cash reserves to be diversified in the future. Remember, I went in and put that 0 to 20% for equities in there to show diversification. Regard has been had to the Reserve Bank Bulletin of September 2015 detailing long-term property trends in Australia. The trustees are comfortable barring any immediate disaster. The cash flows and member benefits will be increased over time to maximise retirement income through the holding of the property. We go through risk return, then we go through all the major asset classes, domestic cash, and you can see here, these are all the stuff that I put in, and we've got obviously the holding period. We've also got the reasoning behind it, behind that strategy. Again, international fixed interest equities. Remember, I put that in for potential diversification purposes. I put there in domestic property, we've got in there international property 0, borrowing in there as well. We've got insurances, and again, we've got to obviously review it regularly, which is required by the Commissioner. Now, this is Appendix A, which is long-run trends in housing price and growth. This only happens if you tick over the 50% box. So this is not just over 90. I'm looking at putting this in as evidence for any property investment that's greater than 50%. So I think that that's absolutely crucial. It's a great paper, have a read of it, but it really talks about the long-term demand. Look, anyway, looks at housing prices over a period of 30, 35 years. So look, over that, income flows, demand and all that, it's a really absolutely awesome paper. And for anyone who's got property inside a fund, even if it's a direct property, absolutely crucial to have this paper there. So it's quite a long paper. Again, we want to beef it up, show that we've done our work for our trustee of the fund so that we can justify our fee. Again, it's 2015. So the trustee meeting, acceptance of the fund's investment strategy, we've got the date there, and then the adoption of the investment strategy to cease the fund's formal investment strategy, adopt the current one, and this is obviously for the 2019-2020 year. and then signed by the trustee of the fund. And that's effectively what we've got in terms of our investment strategy there. So that's the way that I would look at it. Remember, there's the letter to the client. If the client doesn't want to go down that track of doing the letter, then effectively what we want to do is we want to make sure that if they're not going to go down and do the letter, then we do get an indemnity, and particularly for auditors. Auditors, I believe you should get involved now for the 2020. I think it's absolutely crucial. Get the investment strategies up and running as we see fit. Let me have a look at a couple of questions. Do you have equivalent research paper for commercial property? Thank you, Andrew. No, but I can get one. With the system we run, as you can see, it's pretty automated. And again, I'd encourage you all to come along to our roadshow for that. We've got, it's all throughout Australia, but if you come along to our roadshow, I think the early bird pricing is 195, which is great. You will be building all these strategies. I've got everything under the sun. So make sure you have a look at the whole agenda there. But I've got 20 strategies and around about 5 case studies. So by that time, I will have a paper on commercial property and also one for equities as well that we can basically put into that system. So Angela, if we prepare investment strategy for the 2019-20 year in April, May 2019 and request a client to review it, if any changes will be made to notify us any changes, if there are no changes, then sign the return. Investments due as a broad range on previous year, each 20% cash put in 20, would this be fine? Again, if it's for the 2020 year, if you put in for April, May 2019, it's okay. But again, we want to go through benchmark asset classes. You want to go in between 20 to 30% benchmark from my perspective, but that seems to be a-okay from my perspective. Just make sure that you do have a trustee meeting to adopt that, and they know. Can the auditor provide the trustee with investment strategy template? I would say there is no way in the world an auditor would do that, not after Cam and Bear. The auditor is there to assess and test the compliance of the existing investment strategy. John, investment strategy is expressed in broad terms, percentage of assets, types, real property, etc., land formation data, so resolution trustee fund that we've reduced them. So that seems okay. Graham Davis, the frightening thing here, Grant, is the auditor's assessment of investment strategy. What recourse would a trustee have in relation to challenging the auditor's assessment to the ATO? Again, that's a really good, Graham, that's a perfect question because I do find on a number of occasions that we have received from advisors that an auditor has basically said no in relation to something. In fact, had just one recently, an advisor had put in place for a client a promissory note as a contribution at year end, and the auditor was going to issue contravention notice of that because a promissory note wasn't a contribution. And then the advisor obviously took them. One is you've got to liaise with the auditor and show them, look, this is the case. But certainly it's a bit both ways, as that puts a lot of pressure on the auditors, which hence is why the auditors should really get out and do their thing now. Scott, really you want to charge clients for unfounded hysteria? Let's now look at what clients want. The fact that some of us are bound by ASIC to act in the best interest of clients. Is it really in the client's best interest to do a document just in case and charge a fee? Well, that's fair enough, Scott, if you feel that. But, if you've got a... Look, if that's the case, you don't have to charge the client. If you're really involved in the client's affairs and you believe that it's worthwhile, I would go and be doing the documentation, just saying, well, this has come up, then effectively just go and give it to them as part of a freebie. But again, that's up to you, Scott. And look, I'm calling the shots as it is, but given the potential downsides, for the client, I'd simply be going to the client saying, look, this has come across. If you don't want to do the work, if you're bound by ASIC, then effectively I would go down the track and just make sure you get an indemnity. Lynn Cullen, hi Grant, do you have a questionnaire for the client to complete in order to obtain the investments for each asset class? If we're completing the checklist, the investment strategy without them having completed a questionnaire, I feel it's leaving me open to being accused of giving financial advice, but I'm registered to do this. I'm a tax accountant. Look, that's a really good question, Lyndall. What I'll do is I might actually go through And if you leave it with me for a few dates, I'll actually put all those asset classes up there so the client can go through and they can do a bit of an information sheet there for you. Alternatively, you can sit down with them at the time, which I think is probably a good idea. It gets away from Scott's hysteria issue. Sit down with them side by side, or do a Zoom conference and let them complete that investment strategy you just did. You can certainly go through and fill in all the trust details and then go through with them and say, look, is it 0 to 100%, 0 to 100%, so on and so forth. So it's not a bad idea. And remember, if someone's received this letter, they actually do have to comply with it. Is investment strategy required every year or every third year? Basically, John, would be every year. You can actually carry forward. I mean, if there's been no change in last year's investment strategy, just simply have a minute from the trustee that you're ratifying last year's investment strategy for this year's investment strategy. Can you please show where it covers future cash flow requirements? I haven't got enough for that, Deepak, but as I said, you'll be able to just jump online, and if you do investment strategy, you'll be able to cover that as well. How do we deal with the 2018-2019? That's a tough one. What I would do is we can go through the past, and we've done it from a legal perspective. You can do a ratification. So you could use it on a system, and then in the trustees minute, what you do is you ratify it and just simply put a note that the deed itself or the investment strategy is a record or a ratification of what was going in the 2018-2019 year. So there was a verbal indication from the trustee. Now what we're doing is we're putting it in writing. So we call that a deed or a ratification document. Notwithstanding the investment strategy, the financials for 2020 show property 91% shares, 6 and 6. Is this okay? It's up to the auditor or the ATO. Well, really, it's up to the auditor. I would have thought if it's 91%, if it's 91% property, I would have thought that the auditor, given these guidelines, is probably going to want to see a diversification. It doesn't mean there's anything wrong with it. It's fine. Can we get a copy of the letter sent to clients, Rachel? Absolutely. That copy of the letter is on the LightYear docs. As I said, if you just simply want to go to the position here, you can see, so I'm just moving my stuff around the support center. Go to the far right hand. You'll see there, can you see that letter there, Rachel? You get a copy of that, just the client investment strategy. So please feel free to just take that. There's no cost on that one. Graham Davis, Grant, I've actually seen an auditor accept a CFS investment profile of a fund unrelated to the SMSF. Again, that's called Cam and Bear. And remember 54B. So again, we can get in really, get a position of getting ourselves concerned about being sued. Remember the ETF, XYZ ETF case? The last year, I argued that a lot of members could sue for investment strategies. Lam Ewan, is the investment strategy required to be reviewed and updated? How often? I would generally do it each year. Again, as I said, if you do a good one now, and it hasn't really changed next year, so when it comes around to 1st July next year, simply ratify and just do a meeting and say, look, this is A-OK from our perspective, and we're happy to go with the investment strategy. How long can you do that? You can do that like 5 or 10 years. It's again, you're just showing your mind that you're intending to do that. If your client does not give you an indemnity, what should or can you do? Look, I think it's important. You could probably do it the reverse way around and say, look, if the client doesn't want to give you indemnity, just simply go out and say, look, we're not having anything to do with that investment strategy. It's simply your responsibility. Send them on if they want. Send them on to our site, and they can build their own investment strategy if they want. It's only $49, so that's not a bad idea. How much should you charge for this meeting and document? As I said, Lan, I would say that's probably, I reckon about 350 is about the position. In fact, I'd probably build it, with them in mind, or if I do that interview question, I think it's not a bad idea. But definitely you should get indemnities for clients. Whenever you have a strategy with a client, they don't go ahead with it, make sure you do an indemnity. We've got another question here. Preparation investment strategy considered financial advice. Investment strategy is not a financial advice. Your licensee may do it, but under the Corps Act, Clive, it's not classified as financial advice, and that's just simply Corporations Act. So I think if it's an accountant, then if they've got a financial advisor, okay, it's when you get down into choosing specific investments, that's when it becomes financial advice. But when you start going across that, and again, there should be a collaborative effort between yourself and the trustee, because there's no way the accountant is going to work out the benchmarks, but they should say, okay, your strategy, what is your percentages there? Actually, being an accountant, how can I assist a client to prepare the investment strategy without AFSL? As I said, it is not AFSL doing that. I'll send out that letter with that one. What I might do is I might update that letter to cover a lot of those benchmarks there as a preparatory if they want to do that. That way, if they're feeding it to you, then you can simply prepare that as a matter of record, which is important. Again, can I provide them some sample documents? Yeah, absolutely, if you want to do that, or just send them to our site and let them do it there themselves. Can accountants really do this, or should we be going to a financial advisor? The problem is about this, Carmelina, is if you're going down property, there is no licensee I would know, or an AFSL around Australia that would sign off on property. So you're sort of stuck between a rock and a hard place, because a property is not a financial product per se, and an AFSL is not going to want to go down that track. So as I said before, it is not an investment, it's an investment strategy for the client. It's an overall plan, not a making of investment, which sits outside of the Corporations Act. Again, be collaborative. Can we prepare investment strategy for 2018, 2019 now from your LightYear docs? Absolutely. But what we need to do is just put in place there that it's actually a statement of record of the 2018, 2019, unless you want to change the dates. Anyway, that's enough from me. It's Grant Abbott shooting off. I think we've got to the end. Please make sure that you have a look at the roadshow coming up. I'm going to be going through a whole lot of investment strategies, but a lot of strategies for the day, contributions, bring out our whole estate planning suite. You'll be able to do family trusts, binding nominations, you'll be able to will, super proceeds trust, and my new SMSF testamentary trust, estate planning reserves. We're going to be looking at property development, doing lots of stuff, how to get monies out for people under age 50. So again, it's only $195 at the moment, early bird. So book in now, and you're going to get, we'll be doing a lot of the documents on the day on the LightYear Docs site. You'll be getting $2,000 credit on that day to build as many as you want. So again, thank you very much. Last one, Dennis, how does a unit trust fit alongside the SMSF trust and the requirements of spread diversification? So if it's a property trust, again, that should be classified as, depends on whether it's residential or not. So we should take that into account. But obviously, if the trust, it would depend if it's a syndicated, you may not be able to get out of it quickly. But if it's a large, for example, a large syndicated property trust where you can get out, then that obviously gives us diversification. Anyway, thank you very much for attending, everyone. Love to see you at the roadshow, and I'll be sending this through to you very shortly. Anyway, it's Grant Abbott signing off.